Okay. I don't know what happened here. Hang on. Mm, Okay. All right. Can everybody hear me? Back in action now? Good? Okay. Everybody, or it's just Section 8 stuff here. The limits to the assets or the unlimited assets thing is gone. Now we have a $100,000 asset cap. Um, this again is one of those inflation kind of things that can change, but for 2024, there's a $100,000 asset threshold for total cash value of all eligible assets. That is kind of a lot of money, but I think there are a few people that could be at that point. But remember, this is for the eligible assets, which no longer includes retirement accounts. Those those aren't in that total anymore. So hopefully those assets don't really get that high up. Otherwise, they should probably be talking to a professional and to invest their money properly or something. Um, what this essentially means is that they're ineligible. Their application has to be denied or their subsidy has to be terminated. This starts with the first full certification in 2024. But HUD has given us an enforcement delay option. So we can basically give them up to 6 months to cure that um, asset cap disqualifier. Um, so if on a January restart, if they're over that $100,000 asset cap, in July, we would send them a termination notice, a 30-day notice that they haven't cured their assets yet, and their subsidy will need to be terminated unless they do something immediately in the next 30 days. Um, it's kind of a big one, but there's one more asset restriction here that um, is a little bit more of a sticking point for us, and that's real property. So again, the whole no limits to the total assets or the type of assets in HUD housing is gone. Their Section 8 applicants and residents are ineligible for subsidy if they have a present ownership or legal right to reside in or the effective legal authority to sell the real property that's suitable for occupancy. Um, real property is always considered suitable for occupancy unless it meets certain exceptions or exemptions, not meeting their disability related needs or their family size needs. It's physically unsafe or it's not allowed to be lived in by some state law or local law, like it's condemned, or something about it would pose a significant health and safety risk that's not easily repaired. Or the last exception is that it's a hardship on them, like the commute for work or school or something, or medical treatment is too far for them. Um, then it would kind of meet that exception for being suitable for occupancy. There are also a few exemptions to this real property restriction. If the restriction doesn't apply to any person, any property that's jointly owned by a family member and a non-household member, where that non-household member is living in the property itself, or the real property, not the apartment. I don't know really what that means, because there could be a lot of couples and stuff that the wife leaves and moves in with us, and the husband stays in the house, but they're both listed on the house. I guess that means that it wouldn't be included or something, but I'm still waiting for a little bit more clarification on that. The other exemptions for this real property restriction are any property that's currently listed for sale, or if the person in the family or household is a VAWA crime survivor, or if for some silly reason, if they're receiving a housing choice voucher assistance at that property, which I don't know what that has to do with Section 8, but again, a little bit more clarification is coming on these. Foreclosure is not a valid reason to be exempt from this real property restriction. So we have to report the property if they have ownership interest in it. So if their name is on the tax records or whatever, it has to be included. And if it's suitable for occupancy, they're basically ineligible to live at the Section 8 property now. They have to meet one of these exemptions, or get rid of the house or something to that effect. There's still the same 6-month cure process for that as well, from the first full 24 certification. But I still need a little bit more information on it. There is a self-certification form for a real property exemption that I'm going to have to create, that they're going to have to self-certify every year, in regards to, I put my notes for that, whether they have this real property or not, and if they do, whether they qualify for one of the exemptions. I'll get more into this in the future once we have some details with it. But an important note: if they're using it as a rental property and they have a lease on the rental property, then it would not count as suitable for occupancy, because it's they can't actually live in there because somebody else is living there, and it's basically a business. So I think a lot of the people that we deal with kind of have that situation. But I guess we'll just have to take them each one of these as they come. I don't really have a whole lot more detail for you on that, but both of these restrictions are pretty relevant here, for all of you Section 8 people. Now, also even if they have negative equity on the house, you still be reporting the $0 value, but it could be a real property disqualifier. So even if it's not worth anything, it could potentially disqualify them from being in the Section 8 housing. Another example, even if the property is exempted from disqualifying them, like somebody's a VAWA victim, that's why, or that's listed for sale. If the cash value is over a certain amount, like $90,000, or over that $100,000 cap, even though they're not disqualified for having property that they can live in, they would then be disqualified for having assets over the $100,000 asset cap. Quite a bit of a confusing mess to swallow there. So as far as the terminations for this, the current HUD lease form doesn't really account for this. It doesn't have, it's very specific with the things that you can terminate people for. It doesn't seem to have anything about these restrictions, but they obviously will be releasing a new lease at some point that will allow us to do that. Unfortunately, we won't be able to implement new leases until after the current lease terms end. That's just the way the leases are. So it begs the question of when can we actually enforce this stuff? If we can't really enforce it with the current lease and somebody's disqualified up by their January recert, what do we do with them at that point? I don't really know. So as soon as I get some more details, we will be following up with you on that. There is a new termination certification type for this called, confusingly enough, an AR, a termination AR for asset restriction, not to be confused with the annual recertification. That's for when you terminate their subsidy. Now, there's also a new move-out code for if they decide that they don't want to lose their subsidy and they'll just move out and go back to their home or something. There's a move-out code for asset restriction as well. We can also give applicants who are disqualified for these two restrictions the time to cure. So we could potentially be still accepting their application, but requiring them to get rid of the home or change their assets or whatever to be qualified before the move-in or IC time. Yeah, I don't want to delve too much into that stuff, but again, just use Section 8, folks, right now. Okay,
Brian?
Yeah.
For those of us that have market and Section 8, are we going to follow that same policy for our markets as well?
I don't think so. That's something I'm going to have to talk with EG about, but I don't think that we'll put that same restriction on the conventional people. We haven't gotten there yet. Yeah.
Brian?
Yeah.
Like Dennis says, where there's mixed housing. So if somebody fills an application out and they currently check the box that they want to apply for an apartment and Section 8, and they currently live in a mobile home, which is real common for us, how does that affect their Section 8 application?
It's still real property. If they have it listed for sale and they can show you something that it's listed for sale, then it's not going to disqualify them. That would be an exemption.
But it's normally not for sale at the time that they apply. So if somebody's mobile home is not for sale, they would get a letter telling them that they don't qualify for Section 8?
Would still have to work out the procedure for the applicants for that, but essentially they would be notified that they don't qualify, and at a certain point when they get towards the top of the list, and that we could give them no more than 6 months, but they would have to cure it before we could do a move-in or initial. So they would essentially, I guess, get skipped for up to 6 months until.
Well, but they would be able to move in on the conventional side.
Yeah, but they would be sitting there on the Section 8 list until they cure that disqualification.
Brian, I know you had mentioned earlier when you started on this course concerning Section 8 people and 2028 people. Is this going to affect the 2028 people?
No, this is only straight Section 8. It does not affect 2028 and it does not affect 202 pracs.
Thank you.
Yep. Okay, the there was a confusing name before. When assets were disposed, they were called imputed in the systems and on the 5.9s and stuff, when really imputed has to do with how you calculate unknown asset income. So HUD has gone in and we're going to change that meaning or that word to divested now. So anytime you see something that's like assets disposed of for less than fair market value, those are divested, and imputed really just sticks to calculating the income. And now we're back to everybody again here, not just Section 8. There's a few different flags that to fit with these recent changes that I discussed, whether the asset type is a regular asset, whether it's that real property thing, which would only apply to Section 8, or if it's non-necessary. So there's a lot of new field names and things to tag on here in the software, which it should prompt you to do this once we switch. But there's a lot of new things you will be seeing to accommodate a lot of these HOTMA changes. Not so fast. The dependents and child care deductions. I don't know if we have very many child care deduction people, but there's probably some of you with dependents. The deduction for dependents is still 480 next year, hasn't changed, but it is now one of those figures that can change with inflation. Fosters, we've kind of skipped that one before, but fosters are no longer family members, so you're not going to include any of their expenses, or they don't get any deductions or any of those, anything related to them. They're basically like a live-in aid now. Okay, the elderly deductions. Goodbye to that boring static $400 disabled family deduction, elderly family disabled deduction, and hello to this hot new $525 elderly disabled family deduction for 2024. It's also now something that can change each year. It doesn't, that $125 probably doesn't account to much off of their rent, but it's something kind of in the right direction to help offset some of these other things we're going to get into. This does affect RD. They use the same calculations for rent. The medical expense deduction, I guess HUD didn't like that name, and they wanted to now go with the health and medical care expense deduction. So much better. I'm going to just call it the ham care expenses and deductions for now. It now matches the definition that IRS uses to determine what expenses are included in whatever else with taxes and things like that. IRS Publication 502 has all of this. I put that in the forms folder as well, so we can kind of see what things are going to be deductible or allowed to be deductible going forward. I think I have a typo there, but the medical expenses for fosters and aides are not included. I must have deleted the not there. Oh wait, no. That part is gone. That's why. Boom. And so is the 3% the 3% expense income threshold. We are only allowed to include in that ham care deduction the amount by which the eligible ham care expenses exceed the current expense income threshold. So everything that was above that 3%, that kind of like a deductible, is what would count as their actual deduction. Instead of 3%, now we got 10% in January of 2024. And that is subject to change, but it might not be something that change. It's not with public data. That would be some other HUD notice that would have to change that particular one. So what that means is a lot less of their expenses are going to be deductible, right? That's going to really affect their rent calculations, but we'll get to that in 1 second here. HUD has also changed the name of the disability expense deduction to the mouthful that is attendant care and auxiliary apparatus expense deduction. I don't like that one at all either, so I'm just going to call it the assistance expense. The eligibility for the disability or the assistance expense is still the same. It must enable a family member to go to work or look for work or go to school. I don't know if we have a lot of these with you guys, so I'm not going to go too far into it, but it now follows the same. It did before, but it is still following the same thing. So the threshold is at 10% now. The how is this going to affect everything? Really, let's see here. Well, the threshold goes from 3 to 10%. Their tenant payment is really going to be impacted. But HUD has given us 2 more types of hardship exemptions to go with this. We didn't go over the other ones because they're not very common or whatever. But when the first one is called phase in, so it's going to slowly bump them up to that 10% over a 2-year period. So instead of on January 24 going right to 10%, in 2024 it's only going to go to 5% from 3%, and then in 25 it's going to go to 7.5% before 2026, where it hits the actual 10% like everybody else. Now this is automatic, but it is only for the people. It's automatic in the software. It'll just kind of do that if the people are eligible. And to be eligible, you have to already be receiving HUD assistance, and you have to already be receiving some type of deduction, a ham care deduction or an assistance deduction. On a 2023 certification. A special note, it does not have to be our certification either. If they're coming from another HUD property and they move in or do an IC with you guys, if they give us a certification from their last property showing that they were receiving HUD assistance and some type of deduction in 2023, or in 2024, if we're doing this, next year, as long as it was in a certain time frame, then they would be able to continue their phase-in period. The phase-in is a temporary thing, and it's only those specific years. Once we get to 2025, there's the 5% from 2024 is no longer possible or whatever. If they moved in 2025 and they're eligible for this and we flag them, then they would get the 7.5% instead of the 10. And then they would switch to 10 in 2026. Once we get to 2026 or 2035, it'll just be at the 10%. There's no phasing in anymore beyond that point.
Brian, you said something about if they were previously receiving a deduction. So if we do an IC for someone that currently lives here, they've lived here obviously because of our wait list longer than a year. Mm-hmm. Do they go straight to the 10% number?
Yep.
Okay.
Yep. The other hardship exemption for the ham care stuff is it's called a financial hardship exemption. This one is everlasting for the most part. They can always kind of request it, and it just bumps it right down to the 5%. They have to request it. We have to define a policy for when they're eligible for that, and when they can, like what it means to be in a financial hardship that's eligible for this exemption, which I don't know. It's going to be pretty slim and hard to get to if I can figure out how, but so when they request it, it would last either to the earlier of 90 days or whenever that actual hardship ends. Now, at the end of that 90 days, it can continue to be extended additional 90 days to keep it at that 5%, but we have to have documentation showing that we reviewed it and renewed it and has to be maintained in the file. And um, yeah, so it's not really something that I want to announce or put out too much, but okay, so let's see how this actually looks. Now this next slide is going to be kind of a lot. So the first two columns here is like a general comparison of how the calculations differ going from the current 3% to the 10% next year. I only gave them like a 5% income increase for this first HOTMA year. The expenses all stayed the same. It's just a minimal income increase, but it results for these people who had 5,200 in expenses, an $83 increase in their monthly rent, jumping to that 10% because their deduction is basically half. But if we do the phase in 2024 at 5%, it's really only about a $47 increase for them. Now, this isn't a perfect example for everybody. I don't know. Some people have a lot of expenses. Some people don't. This particular example is a couple, so they have more income that threshold kind of cuts out of. But it can kind of just illustrate what to expect. So we're going to have to notify the residents really that this stuff is coming up. And I know a lot of you guys have recently just dealt with a lot of unhappy residents from your October rent changes. Well, maybe some of you, I guess that's a lot of the conventional people only that aren't here at the moment, but some of you have had that joy. And now it's going to affect the Section 8 people as well. Luckily, you can just kind of throw them off to North Tampa for some of this stuff because it's out of our control. I got about 10 more minutes on this one, so we'll start trying to cook through it a little here. So when we're doing this, there's kind of a delay into when we're actually going to get into using Tracks 203A and the new HOTMA stuff because it has to be implemented into the software. And we're doing this stuff months ahead of time, right? So the January research we're starting next month. Some of the stuff we have to account for, but a lot of it we can't do until the software is ready to do it. So we're creating a 2024 certification in the current Tracks 202D that needs to be in 203A. So there's a lot of factors there as far as the deductions and things that's going to change the rent calculation once we flip the switch over to 203A. And HUD basically requires us to do that, to make those corrections from the 202D certs to 203A. So anything in 2024 has to be in 203A's version as soon as we make that switch. The software is supposed to just automatically do all of those corrections. So it will kind of make it a little bit easier for you, but it can kind of create tricky situations where we have a bunch of lost rent because if their rent goes up because of these calculations, like it's probably going to based on the way the deduction threshold thing is affecting their rents. It's not their fault, so they're entitled to a 30-day notice of a rent increase when they find out about a rent increase. They're entitled to 30 days before they have to start to pay it. So if we don't implement this before, let's say like February or something, by the time we can get it going, we have potentially January and February recertifications that we would immediately have to correct. And if their rent went up, we have a couple of months of rent adjustments that HUD's taking the money back and we can't collect that higher rent. Plus we have to wait another month before we can charge the rent to the resident if it's higher. So there's 3 to 4 months there where of lost rent just by doing this switch that was no fault of anybody's. How can we handle that? Well, HUD is kind of giving us another little trick here to be able to deal with that. When the software automatically creates those corrections, they're also supposed to use a manual accounting request code that gets put on the voucher that will offset all of the adjustments that the system automatically makes. So if there's $400 in adjustments that were taken back by HUD and we can't collect from the resident, then you'll have all those adjustments on the app, but you'll also have this new HOTM code that's added to balance that out, so we can still get be made whole, and we don't have the lost rent, which is going to be important because it could be a lot for people. Yep, there we go. So the other change here that is a really good one for you guys. The 9887 is now just one time. We're not doing it every single year at research. You don't need to do it at move-in. You just do it with the application, or at least prior to the detailed screening portion of the application. Now, there are a couple other times where you need to do it, like when a new family member is added or somebody turns 18, something like that. But it will stay in effect from the time they initially sign it until they move out or their application is denied, or if they revoke that permission, which means they would be denied admission or terminated for not complying with the program. So they wouldn't revoke it, I don't think, but that is a huge thing. But it will be a new form, and once HUD kind of gives that to us, I'm assuming we will just have them sign it at their next recertification, and then that'll just be the last one for that. Another change that's pretty nice, the income reports are no longer required at every single interim recertification. According to our own policy, we can kind of decide whether it is. It's useful sometimes, but if it doesn't have any, if the IR doesn't have anything to do with changes that can be dealt with by data in EIV, like a Social Security change or a Medicare change or something, then there's really no reason to be pulling the income reports with the IR. But previously we had to, but going forward we won't. So that's one little less thing to deal with. Has nothing to do with RD since they don't do EIV. Maybe they will coming up. I really don't know. Another small change here, it's called means tested verification. What that basically means is that we can use a verification from some other federal program as verification of income for our program. So if they're coming from another HUD property and they have a bunch of or some kind of weird income, instead of trying to send it out to some place, we could just take their 5-9 and use the information right off of there. It sounds nice in theory, but there's a lot of issues with it, especially using other programs like WIC or Medicaid's or a tenant income cert from some other state or something. That the income things might be different amounts. It could throw off EIV income discrepancy stuff. It's really just kind of a last resort for option to have another way to verify things. And in some cases, if a resident or an applicant is filling out all kinds of forms and applying at all different places and programs and stuff, and they get all ornery or something about having to do more verifications, and why can't you just use these? Well, now we can, but I don't necessarily recommend it. But if there is some type of a discrepancy, we have a safe harbor that HUD is just kind of like, okay, it's fine, even if their definitions of what is income in the program that we're using is different from the ones that we should be using with HUD. Last resort is really, let's just leave it with that. Now, interim recertification. The threshold for that, the qualifier, was always $200 a month that it was required. Now that's gone as well. The new threshold is really just 10% of adjusted income in either direction. But now, in addition, where are we at here? It still has to be done in 30 days or less, in like a timely fashion. But we can decline to process the IR if we estimate that their income isn't going to decrease their adjusted income by at least 10%. So if the change is under 10%, then we can say no, sorry, forget about it. If it's so these little things back and forth, moving up and down, kind of eliminates a lot of that. We will have to process it though if we become aware of an increase over 10% or a decrease of 10%. Except, this is another thing that kind of needs a little bit more clarification. We will not consider any increase in earned income of the family when we're doing a calculation of adjusted income. If the family's adjusted income has increased, unless the family previously received an IR during that certification. So if their adjusted income increases from things other than earned income, we wouldn't really be verifying those changes on the IR. I'm gonna have to send out another meeting thing because it's about to kick me off. So stay